What's up, YouTube? In this video, we're going to go over Cargurus, ticker symbol CARG. They reported their earnings November 7th and beat on top and bottom line, and analysts have revised their future expectations higher for the company. Currently, year to date, company's up 39%. Over the course of 1 year, it is up basically 43%, and it has a fair amount of short interest against the company right now. So they finally finished their acquisition of CarOffer for $75 million. They originally acquired a 51% stake in CarOffer in 21 with the ability to buy the remaining over the next 3 years. Now that they own CarOffer, one of the things, this is from their Q2 earnings report, is the last 3 quarters with CarOffer, they lost dealer confidence because they were not doing enough inspection work, or maybe not well enough inspection work. And one of their deals is if a dealer wants to buy this vehicle, CarOffer is supposed to inspect the vehicle and then hands it over to the dealer. Takes care of all the logistics and everything. And then when the dealer receives this vehicle, if there's over $1,000 worth of damages, CarOffer has to cover all those damages. So CarOffer was losing a lot of money because they weren't doing inspection work on their vehicles that they're purchasing, which I think is, especially in the vehicle world, that's something that should be on 100% of your vehicles. And right now, I believe they're only doing like 70% inspection on all their vehicles. I think that should be 100%, not just 70%, in my opinion. So personally, I am not a real big fan of this acquisition. I don't really like this particular business model. Maybe it could be profitable, but so far, based on what they have seen, it is not that profitable. So I think they made a mistake on this one, but maybe they'll turn things around and maybe it'll turn out to be a pretty good business for them. But because of that, they do have earned back some dealer confidence, and maybe they can do that by stating that they're going to be doing better inspection work. As you can see down here, they're basically saying they're doing CarOffer 2.0 to get back up the volumes that they want and play offense and growing and profitable business as we go forward. So they're clearly very well aware that they've got a lot of work to do and basically restructure the business and make it better than what it is now. A couple positive things. They are turning a profit in their UK business this quarter. So that could tell them and give them confidence that they can potentially operate on a more bigger, broader global scale. So that'd be very good, more revenue for the business. Also, in the United States, they introduced, or actually a reiteration of, Instant Max Cash Offer, and it is now called Sell My Car to Top Dealer Offer, which gives consumers the choice to either sell their car entirely online or to the highest bidding local dealership. So I think that this particular business model, I think, is actually going to be very widely used and probably very widely profitable, depending on how this all works out. If they get a percentage or how that works, I don't exactly know, but I'm sure they're going to be making money on that one way or another. So over to the 10Q and onto their balance sheet. Company's got $447 million in cash. One thing that I could not really find an exact description of what their inventories are, but their inventories are down substantially year over year. They went $5.3 million in inventories to $323 million in inventories. And they don't hold any physical vehicles. They're just the middleman on these vehicle transactions. So I'm not exactly sure why they had $5.3 million in inventories and now they're down. I personally could not really find a clear-cut answer to that. But regardless, inventories have been cut down substantially. And because they don't hold any physical vehicles, I have to see that as a positive, but if they were a car dealership, I would see that as a very big negative. But down here too, the liabilities. Company's got only $305 million in total debt, and they've got $447 million in cash, so they are a net positive cash company, which is very good on the balance sheet. Very strong balance sheet. One thing though that they added is $140 million in operating lease liabilities. I'm wondering if that doesn't have a lot to do with this, with CarOffer. Maybe CarOffer had a lot of lease liabilities, and that is why there's a big, huge jump in overall leases. Over to the income statement, we've got 3 sources of revenue here. We got marketplace, wholesale, and product. And we come over to here, we can see marketplace grew year over year. Wholesale got cut down by more than half. And we also got product that went from $214 million in revenue down to $20 million in revenue. Now, ordinarily, you'd see that as a negative, but you come down here to product, cost of revenue, basically that section of the business makes no money. So it's almost like, I personally, I see it as like, okay, I'm not don't care. Because once we see here, we got our overall total revenue went from $426 million down to $219 million, but our gross profit is up by about $15 million, mostly because the only thing that we saw a reduction in was in product. Obviously, you see a reduction in wholesale, but we see an increase in marketplace. Their main business here is the marketplace sector, and that is growing and doing good. And I think that is the one to be paying the most attention to. Obviously, product was their biggest one last year this time, but obviously that doesn't make any money for the business. It actually costed them money last year. So down here into operating expenses, we can see a huge, about $20 million uptick in SG&A. Well, actually just G&A. I'm assuming that also has a lot to do with the CarOffer acquisition. So overall, a company produced $23 million last quarter in income from operations. And then after you deduct out taxes and other things, they are left with $22 million of net income. Onto the cash flows. In the last 9 months, company did $45 million roughly in consolidated net income. They get to add in depreciation of $35 million, deduct out deferred taxes. So that's basically washes out depreciation. Then you add in some stock-based compensation that they're paying out of $44 million almost, which is kind of a lot. You come down here, you have you're basically cash from operations of $122 million. You minus out your capital expenditures, which leaves you with $113 million in free cash flow in the 9 months. So positive free cash flow and a net positive balance sheet for cash. So very good. Company is buying back shares. They did authorize a larger share buyback program as well. Obviously, since they are handing out stock-based compensation, that share buyback program really is just going to be buying back stock-based compensation shares. So it's not really too big of a deal. But obviously, we can see in the last 9 months, they did buy back more shares than they handed out. So that is very good to see and good to know. On to the valuation spreadsheet. We're going to look at the charts on the right-hand side. We've got a revenue, gross profit, and net income. We can see where everything is trending. We can see revenue peaked and is pulled back, but gross profits have leveled off, as we can see on their 10Q, that gross profits did not get affected by the revenue decrease, which is good. And same thing with the overall net income. Obviously, you've seen a little bit of a reduction here, but revenues, even though revenues had peaked there, they did not affect the bottom line, which is pretty good. So gross margins, we can see they've done a much better job of having better margins overall, sitting at about 90 something percent, currently sitting at 75%. So they know how they've done 93% margins before. So maybe we can see them start running these margins back up higher. Net margins, same thing. They've done a better job on the net margin side of things. So maybe we can start to see them sneak back up above 10% on margins as well, because they've done it before. They can probably do it again. Revenue and gross profit year-over-year change in the trailing 12 months. We are seeing negative revenue growth. Obviously, we already saw that. And gross profit, slight decrease in gross profit growth as well. Return on invested capital sitting at about 5%. PE ratio today is about 27. Earnings yield sitting at 3%. Cash to short-term debt, we already took a peek at the balance sheet. Very strong balance sheet. Net income to free cash flow, it does produce more free cash flow than net income, but we know a good chunk of that was from stock-based compensation and depreciation as well. Free cash flow then is $192 million. It is in a good upward and is maintained positive free cash flows for the existence of the IPO. Capital expenditures are starting to increase a little bit, probably potentially with the acquisition of CarOffer. Share count dilution actually staying pretty stable, even with stock-based compensation getting thrown in there. They must be buying back enough shares. As we can see, they have been buying back some shares as of lately to combat the increase in share count dilution. So we are not seeing a tremendous share count dilution at all, and is actually starting to level off, and maybe we'll see maybe a reduction of it in the future. Over to the comps, we have Cars, AN, CarMax, and Vroom. Come down here, we've got all of our charts to compare the companies to with one another. We'll come down here to margins to see where margins are at, and we got Cars, which I think is a more of a direct competitor to Cargurus, so we'll pay closer attention to those two. So we got Cargurus and Cars here, and we can see where margins are. We know Cargurus has had much better margins in the past, so maybe we can start to see them increase those margins again. Overall operating margin, they are doing pretty good. In comparison, profit margin though, same thing. We know they've done a much better job on profit margins, so maybe we can see profit margins start to creep back up into the mid-teens again, in line with where Cars is at. Free cash flow is producing more free cash flow than where Carg's at. Return on invested capital, not quite nearly as good. PE sitting at 14 in comparison to the rest of the market here. We're fairly richly valued right now in comparison to everybody else. Onto the calculator, we got Prudence Valuation giving them a $26.08 valuation today. We do have a negative EPS company on the board here, so get rid of that. So based on our peers, the 3 companies we compare to, gives us a fair value today of $20.51 based on competition. We take our market cap minus cash, add in debt, divided by cash from operations. It'll take this company only about 9 years to earn its current market cap, so that's very good. Price to book, set 5-year average sitting at 7.6, currently today 3.09, and we have a negative price to earnings, probably, because we got negative forward revenue growth, that's why. So PEG ratio is irrelevant right now. Graham's valuation gives them $30.92 per share. Or the discounted cash flow. Company historically has done 75% growth rate on free cash flow. Analyst growth rate 26%. I rounded it up a little bit and put in 30% free cash flow growth rate. That gives them a DCF price per share today of $56.54. Rule 72, we have 3 sources of EPS growth rate for an average of 10%. Then that goes into 72, 7.2 times. That goes into 10 years, 1.3 times. So then we could double our EPS 1 time and then 0.3 times. And that gives us roughly about a 4.25 future EPS for basically $21 per share. On to the final valuation here on our summary. Currently, Cargurus trades for $20.33 per share. Our fair market value is $31. 30% margin safety is $21.71. Analyst price target is $23.33 on the company. So overall, based on what we just went through, every single one of our calculators is telling us that this company is undervalued. Even our 30% margin safety, it is trading below our 30% margin safety. So even if we are slightly wrong on our analysis, we are still able to pick up this company for 30% off of what our analysis is telling us. So over to the stock chart. The company is still locked into a downtrend in the longer term here. Obviously, I cut out quite a bit of tails, but this is the trend that I'm seeing overall on the chart for a downtrend. And then we are resuming in an uptrend. We are making higher lows right now. So we'll have to wait and see what this company does. If they can break through this trend line and maybe come back up to about this $30 price point, and then maybe we'll see a pullback down to our green upward trend line to make another higher high and a higher low again, and maybe we'll start to see a resumption back into the upward direction on this company. Obviously, I think a big chunk of this is going to have a lot to do with to see what they can do with that car offer, and hopefully it does not impact their overall revenues on the business all that much, and maybe they can turn things around and start turning a profit. In my opinion, again, on car offer, I don't think it's a very good business model. I do think their new instant cash offer that they have that you can apply for on their website to sell your vehicle, I think that is a way more powerful tool going forward, and I think they'll do very well with that particular one. But that is it for Cargurus. If you found value in this video, drop a like, subscribe, comment. We'll be back later with another stock analysis video.